So today I'm going to give you the lesson that was intended for yesterday's meeting. The reason why I couldn't join the meeting was because I've had a fever and I'm still currently going through it, but I want to respect my duty as a mentor to you and give you a proper lesson for this because this is one of the lessons that are foundational to your trading. And therefore, today we're going to discuss about risk management and defined trade management rules or rule sets. First of all, what I want you to understand is the trade framework. So this is where our work begins. This is where most of your time is going to be spent. And this determines, before we even think about trade management and risk management, this determines everything prior to it. And then risk management is just going to be applied to this trade framework. So the trade framework. Firstly, what I want you to have, or what we're going to look at in terms of understanding the conditions of the marketplace, is going to be the seasonality or the time of the year in which we're trading. And we have the February week 2 to May week 2 seasonality, where we understand and we understood throughout the last year that May has a deep retracement or a bearish reversal in terms of the Nasdaq, and therefore we're going to trade within this time periods with a predominantly bullish mindset. But I want you to use this seasonality as a roadmap. I want you to use this seasonality as what should happen. And therefore, from this seasonality, you're going to measure in contrast the current weekly and daily market structure, and you're going to understand whether that seasonality is going to occur or not based on the weekly and daily market structure and institutional order flow signatures. We're going to have the June, July, and August consolidation. And we're going to also have the August week 2 to November week 2, which is going to be the distribution and end of year MD closing. So this is the first thing that we're looking at. We already have a pre-decided time period in which we're going to trade based on the year. And within that predetermined period of time, I'm going to have a specific weekly chart bias and narrative. And bias is going to be inside of the seasonality, and narrative using institutional order flow signatures and high impact news drivers, which means that, again, inside of the roadmap, inside of the understanding that the market should move higher in terms of the time. So we've created the yearly accumulation and manipulation, and now we're going to want to see the market going higher in a normal seasonality. We're then going to understand how the market is going to do that, which is the narrative. After that, what we're going to look at is the daily bias narrative within the weekly bias narrative. So we're going to understand the fact that the market is going to go higher or lower for that specific week. And we're going to look for a specific day. We're going to trade within the weekly distribution based on narrative and the high impact news drivers. And after that, inside of the specific day that we've chosen, we're going to have a specific session based on our personal schedule and allowance for trading, which for you, again, is the PM session. So you are going to look for a specific day of the week, a specific week of the month because of the seasonality, and you're going to be a PM oriented trader. Within that understanding, we're going to look for a specific intra-session 15-minute model, and you already know this. It is based on a previous session liquidity pool being taken and a specific time period and a specific target. So the weekly bias narrative. So if we have a bullish weekly perspective, wanting to see some bearish PDRA fail, which means that we have to see the market closing above it, and this is where the recording comes through. Let's assume that right here, this would be an inversion gap, which we anticipate to be an inversion gap. We want to see this CB that would be here fail. Let's assume that this candlestick is not here, but this is how we're going to internalize it. So the market opens here. We would like to see the low of the week being created first. And after that, we're going to try and trade inside of this weekly distribution to the upside. So the low of the week forms by wanting to see some bullish PDRA support price. So let's assume that this is a weekly chart. This is where you open. And I'm going to state the fact that we want to see the market go back into an order block and then reject higher, closing above that bearish PDRA for it to fail. So this is how I'm going to internalize the week before it even opens and before it starts. And the when, because we already know market opens, has to use that bullish order block or the bullish inefficiency to send price higher, where above the CB, so we can see it fail, so we can later on use it as a means of support. But normally we only care about it failing. So if it has to fail, then it has to close above, which means that it has to go towards that level, and therefore we have those as our weekly targets. And then we care about the when, which is given by the high impact news drivers, because we anticipate the market to reject the bullish PDRA higher on Wednesday, Thursday, and Friday, filtering out Monday and Tuesday for the weekly profile of the CPI week. So we want to see the market open, use this weekly or form this weekly low as the CPI manipulation. So we want to see the market accumulate. CPI usually creates the low of the week. And after CPI, we're going to look forward for the market to move higher into our targets. And this also shows us that if the market goes below that PDRA and it is still there and it fails this PDRA and it moves lower, then this also gives us the insight that we might have been incorrect about our bias, and therefore we're going to stay, or about our narrative rather, and we're going to stay sidelined or trade intraday volatility, which I do not want you to do because we are learning how to trade within a one-directional perspective. Given that we are correct and we are trading on Wednesday and we haven't seen the market going above the bearish PDRA, this is how we're going to internalize that Wednesday. So based on the weekly bias narrative, we anticipated Wednesday's trading to be expanding higher, creating the weekly distribution. So this here is a daily candlestick. We have the midnight opening price. The low of the day forms at 8:30 CPI and is followed by the AM distribution. And because you're a PM session oriented trader, we are going to look at this here, and we're going to anticipate the PM session between 13:30 and 15 to go higher, followed by the last hour trading, which creates the high of the day, which is this movement right here. But when we are going to look at the PM session, we're going to understand the fact that the market is going to, first of all, let's look at the whole day, right? Market opens, forms the consolidation, forms the low of the day on CPI or even prior to it, distributes higher but doesn't create the high of the day yet. So the candlestick is going to be around here. The market is going to consolidate around this level. Market takes on a level of sell side, which is also depicted here. Market goes back below the line sell stops, and then this here, so consolidation, lower, higher. This is exactly what we are waiting for the PM session to do. That's why you trade a PM session with the same rule sets that I use for my AM session trading. The market consolidates, lower, higher, creating a daily high, and then the last hour trading closing price. And here is the business. Here is when we can care about the risk and trade management. And this is what we want to see within the daily perspective. So we have a daily perspective higher. We've saw the fact that the market has ran up, and now we are seeing the fact that the market consolidated within the lunch session. And this is our model. So a standard previous session sell side is going to be taken, and that sell side is going to be between 12 o'clock to 13 or 12 o'clock to 13:30. We're going to aim for that liquidity pool to be taken, and we're going to wait for a 1 minute market structure shift between 13.50 and 14.10 or 14.50 to 15.10, depending on, of course, the specific characteristic of said session. So this is a general idea, but we're going to use the example of a 13.50 to 14.10 macro market structure shift. We're going to then, once we have everything done, so the framework which began on the weekly, on the daily, everything is done, so we do not care about it. We now are looking for this specific thing to occur, and it has occurred. Now we're going to only worry about the 1 minute chart, and we are now going to worry about our trade parameters. So you're going to trade with a normal risk, and of course the conditions have to be one directional. So within our one directional trading, we're going to use the normal risk. And if you're going, when you're going to start trading also intraday volatility, you're going to also worry about half risk. So inside of other conditions than the one directional daily perspective, you're going to also have the intraday volatility model, but I do not want you to worry about that right now. And your normal risk right now is going to be in the beginning to use the 0.25% of your full account, which is going to be a minimum of one month. And you're going to target the low hanging fruit, which is going to be the premium CB below the lunch buy sell liquidity pool. So our model, let me zoom in if I can here. I don't know if I can. I can. So our model is market takes on level of sell side. This is where we're going to get out in terms of our model. But if we are talking about getting used to executing and getting used to using the correct risk and getting used to having the correct exit, we do not really care about the numbers, but we care about the execution and taking the trade and feeling the trade and what do I feel throughout the trade. And this is where your model states that you're going to be out, but you're going to use a premium CB as your exit target in the beginning so you can get used to the executions. Once you have done a minimum of 1 month of that, and that's why I've told you that Q1 and Q2 and maybe Q1 and Q2 and that's 3 months basically, or 6 months, but Q1 and Q2 are mostly going to be you doing this exact thing right here. You're going to aim for this inefficiency. Once you're used to it, you're going to increase your risk to 0.5%. Again, targeting for the same thing, and you're going to tape read after your target is met. You're going to tape read the whole movement, and then you're going to stay below or at 1% within the first 1 or 2 years of your development, because we are emphasizing on getting used to executions. So once you're comfortable with the 0.25 and aiming for this, once you're comfortable with the 0.5 and aiming for this, you're going to then come back to the 0.25% risk, and you're going to allow yourself to come out of the comfort zone slowly. So you're going to aim for this lunch session buy side. I wanted to say buy side liquidity pool here. Again, with a 0.25% risk. And again, after that 0.5%, you're going to let it go into this, and you're going to execute and you're going to progress slowly through it because we are getting used to executions. and that is the emphasis. After you're done with that, you're going to use, of course, in the last development stage, you're going to use a 1% risk, aiming for this buy sell liquidity pool, and after that, you're going to slowly graduate into taking a partial at the lunch session buy sell liquidity pool, and after that, we're going to have our final profit at this standard deviation, which is above. We're going to also understand how to trade your stop loss, and I've stated the fact that your stop loss is going to be 20 handles for the NQ. And we're going to get more in depth about how to place your stop, not on a standard handle stop. So we're not going to only rely on that. We're going to also understand how to place your stop in a logical place, not only based on handles, but on PDRAs that we do not want to see fail. But after that, after we get used to just executing and placing a 20 handle stop, we're going to also evolve into, again, understanding logical stop placement, understanding logical stop tracing after we've taken the partial at the buy sell liquidity pool and at the minus 1.5. And one last thing that I want to preach here is the fact that the higher time frame drawn liquidity is going to be never your final target, because you can be wrong and I can be wrong as well. And what do I mean by this? Let's assume that we're trading for this high time frame CB high. So this is our drawn liquidity and this is our daily target. We are never going to aim for that in terms of our final profit, because we can be wrong. And if we're wrong, we do not care about being right or wrong. We care about being profitable. So you're going to take your exit when you're going to be finally into your last stage of development. You're going to take your exit or your final profit, because you can also take partials here, trailer stop here. You're going to take your exit at the lower quadrant or consequent encouragement of this SIBI, and you're going to just tape read how the price is going to deliver to that high time frame CB high. And the last thing that I want you to understand is that, again, you never need much. And I've told you this and I've showed you this one time, because we're treating this like a lifetime career. And I want you to understand the fact that this development that you have right here is exactly the foundation that you're going to rely on into your lifetime career. Because the definition of a trader in recent times has everyone thinking about scam prop firms which train irresponsible and unrealistic trading. And the real definition of trading is being able to do this for a lifetime. That's why we focus on having the correct framework. Then the risk management and trade management is simple. So this is how real trading is actually depicted. It is not starting at 50,000 fake money, demo trade money, and having an unrealistic stop of $3,000, which is unrealistic again, and being able to constantly grow account from $2,000 or from $5,000 up into $50,000 on a calendaristic year is going to give you the mindset and the perspective that you are able to do this for a lifetime. Because if you can grow from 5,000 to 50,000, you're also going to be able to grow it in a calendaristic year from 50,000 to 200 and so on and so forth. So we do not care about prop firms. We do not care about that type of stuff, because that is only short term and that is going to teach you the wrong things. And if you learn how to do this correctly, you're never going to need prop firms in the first place, because you can always take a $2,000 equity and you can always compound it on a yearly basis up into large amounts of cash. This was the presentation. I hope you gained value from this, and I'll see you the next time.